Good morning. Welcome to America First Wealth Management Investment Outlook for September 3rd, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager. And joining me is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Welcome. Next slide, Mike. This is our standard disclaimer. I'm not going to read it, but it just states that we are presenting the views of our investment team for the period ending September 3rd, and these are subject to change based on market or other conditions. This is not investment advice, and this is for information purposes only. Thank you. So what we typically do is we start off with our conclusions, myself and Mike, and then we will provide more detailed information. And this way, viewers can get our conclusions up front and decide whether or not they want to see the rest. But it's all very informative, and hopefully everyone listens to the end. So my conclusions was last week, obviously, NVIDIA had reported earnings on Wednesday. It was clearly the stock of the week. And even though the stock dropped after reporting earnings, when we reviewed their results and the fundamentals and outlook, it's extremely bullish. Secondly, the S&P 500 index is finding technical support with the 10-day moving average. We'll show a chart on that. It's been a very good indicator for the S&P 500 so far this year. We're also seeing more breadth develop among smaller cap stocks. And this is a very bullish sign because viewers will know that for the majority of the year so far, the dominance in the stock market was led by large cap stocks, mainly growth and momentum stocks, and the Magnificent Seven names. The key macro events of the week to look out for are today, Tuesday, 10 a.m., ISM Manufacturing PMI. Wednesday, we have the JOLTS job openings number. Thursday, we have ISM Services PMI. And Friday would be a big day once again with the payrolls and unemployment rate. Next slide, Mike. So taking a deeper dive into NVIDIA earnings that were reported last week, their Q2 earnings, 68 cents versus 65-cent estimate on the street. That was a 3-cent beat. Revenues were $30.04 billion versus estimates of $28.74. So that was a $1.3 billion beat on the revenues. They guided the next quarter revenues higher, $31.85 billion to $33.13 versus the street consensus of $31.71. So we have a beat and raise. And to top it all off, they approved an additional $50 billion share repurchase. And that's on top of the $7 billion that was remaining in their previous share authorization. And this is kind of interesting because people who follow share repurchases like we do know that this year a 1% excise tax was implemented on corporate share buybacks. So if NVIDIA completes this 57 billion share buyback, they will be hit with a tax bill of $570 million. That's a big tax bill for any company, but the thinking obviously is that they will increase shareholder value by considerably more than the tax bill. But it is a big tax bill, and it just shows the strength of their cash flow and positive outlook. Also, they announced no additional delays in their new Blackwell GPU, and they'll begin shipping in volume in Q4. And demand for Blackwell is well above supply, so that's also a very bullish signal for fourth quarter and into 2025. Next slide, Mike. And this is just the chart I showed. The dashed red line is the 30-day moving average, which has been a pretty good signal for NVIDIA. We're right at the 30-day moving average, and we expect it to bounce from here. If it does cross below that, we don't think there's too much downside given the positive fundamentals, and we think that analysts will say that the pullback after earnings was healthy and it's a good buying opportunity. Next slide, Mike. The weekly market stats for the week. It was a choppy week, as you can see. The technology stocks, NASDAQ 100 was down. Small caps were down a little bit, and growth was down a little bit. However, traditional names, led by Dow Jones Industrial Average, was up for domestic stocks. Value stocks also did well, up 1.3%. International was up a little bit. Bonds were down 51 basis points as measured by the iShares Core U.S. Aggregate Bond ETF. And that's largely due to a pickup in 10-year Treasury rates, which we'll show later. For the month, we have positive returns pretty much across the board, except for the Russell 2000 index, which was down. However, if you go over to the next column, on a quarter-to-date basis, Russell 2000 small caps have been the leader across the equity categories, up 8.3%, which is why we are saying that the breadth is improving for small caps. Obviously, the longer-term numbers are showing much better improvement at the quarter-to-date versus the weekly or month-to-date. But we do feel that the breadth has been improving. Year-to-date, the leadership continues to be large growth. The S&P and NASDAQ are also performing very well. Next slide, Mike. This is a slide of the S&P 500 index, and we're showing the 10-day moving average here, and we're right at the support at the 10-day moving average, and we do expect the S&P to continue to rise based on this move. We are bumping against a previous top, but I think we will exceed that given the lack of negative news early into this month. Next slide, Mike. Turning to the 10-year Treasury yield, we've also been showing the 10-day moving average here, and we can see that for the week, the 10-year yield moved up 10 basis points, up to 3.91 versus the previous week 3.81. Year-to-date, we were flat, but now we are up 3 basis point year-to-date. It is kind of a slight bearish signal for the interest rates to cross above that 10-day moving average, but we think that could be an increased allocation to stocks versus a sell-off in bonds from either foreign investors or other large entities. So we think it's more evidence of a reallocation to more stocks, especially as the month came to an end. Next slide, Mike. Turning to the yield curve, we don't see a lot of action from week to week. Looking at the blue and purple lines, we are a little bit higher at the long end, so just a slight pickup. The short end pretty much the same, and we're still yield curve has shifted down from the quarter end June, which was the top line. We still have an inverted yield curve, but again, it's normalizing from the 5-year out to the 30-year, and we'll be watching carefully to see what happens at the upcoming Fed meeting regarding the Fed funds rate, and hopefully that will impact the yield curve at the short end to shift that down. Next slide, Mike.
Right. So my conclusion is that the economy is still very strong, and with the Fed cutting rates, whether it's once or twice or 3 times this year, the economy will reaccelerate and could drag inflation up as well. So it will be a very, very interesting time when in all my 40 years of watching the market, I think this is the first time that the Fed cut rate when the economy is still running along very strong. So their preemptive move to prevent a recession could backfire in a sense that an early cut would stop the inflation from declining further and make a U-turn. So it'll be very interesting to see if that turns out to be true and how they're going to handle a terrible situation at that time. Do they stand still after 3 cuts, or would they be forced to raise rate again? We should obviously jeopardize their reputation and send the dollar down sharply. All right. The other big thing is, I want to show data, updated data that the fiscal deficit is out of control. And this means that they're going to see, guess what? More supply, okay? More supply of treasury bond. And whether you look at interest rate or prices or anything, it's about supply and demand. So if supply comes in more, the question is, will there be more demand, right? So economy, well, this is the Federal Reserve model itself, one of the best I've seen, the Atlanta Fed GDP now that incorporate all the recent data that comes out. They will be plugged into their model. And what are we looking at? Well, it's running at 2.5%, right? 2.5%. And this is above the speed limit. The speed limit, or what we call potential GDP, is 1.8%. 1.8% is the fastest rate we can grow, given the amount of the level of productivity and the labor force growth rate. So now we are going still going faster than our potential GDP. That means that the underlying pressure for wages is still there, bubbling up, right? Home sales surged to the highest level since May 2023, and contract signing jumped to 739,000 in July. Inventory fell somewhere, but still near the highest since 2008. And new news, if the Fed were to cut by 3 times, that's going to bring the 30-year mortgage rate down, and that's going to add power to the housing market. And when somebody buy a house, there's a lot of ripple effect spending, right? I do not know of anybody who moved into a bare house, right? Before you buy the house, you start shopping for furniture, like an oven, a toaster, washing machine, dishwashing machine, and so on. A lot of money to be spent, right? So this is, well, usually when the Fed cut rate, they cut it at a time when the housing market is very depressed, and that's where they want to spur a lot of new spending and push the economy up. And the consumer is still spending as if we are post-COVID. They are still what we call revenge spending. They're used to going out for food, going out for lunch and dinner, going on vacation, and so there's no dip at all. Right? Recently, there was more dip down here and a dip down here. But you look at it, it's just like, all the way up, spending, right? So much so that they've used up a lot of their savings. All the free money in COVID are all gone, and they dipped into their savings, and now savings have dropped to 2007, 2008 levels. So the question then is, will they continue to spend on borrowed money using their credit card? And why are they spending? Well, they're spending because a lot of consumers are very comfortable with their job. They don't think they're going to be laid off and spend money today, and next month the paycheck will come, right? So hiring is down, but companies aren't firing as they would in a recession, right? So if you look at the jobs layoff and discharge rate, blue color, oh, we have a negative. So there's hardly any spike up in people losing jobs. right? So that's great news for the consumer, but it's terrible news for inflation. And the WARN data is where a large company that have an intention to fire workers, they have to file with the authorities, telling the authorities that we are going to be laying off so many people in the near future. And you see this spike here. See this huge spike here. And there was some move up, right? Okay, and subsequently came down, and you can see that it is a very good leading indicator for the initial jobless claim, right? And now we see that not only is the jobless claim number not moving up, the WARN numbers are saying that we are going to see even lower claims number, right? So, so here you have data very clearly telling us that the labor market is very, very strong, right? So moving to the bond market, you know, this kind of chart, you know, I can understand numbers, but when you think about it, it's very difficult to accept, because when you look at the US government interest payment as a percentage of tax receipt, we have a spike up, right, to 35%, right? To 35%. So roughly 1/3 of the tax collected goes to paying interest. So let's just sink in for a moment, okay? Right? Any businesses, right, that have to pay 1/3 of their revenue as interest is not viable, right? Something has to be done, right? And unless something is done, we could revisit the 80s when interest rate hit 50% of tax receipt. Well, the big difference is that in the 80s, well, interest rate were much, much higher, okay, compared to where we are today, right? And are there other data that help us to think this through? Well, this is the chart showing the US 10-year yield, right, push forward 6 months, right, the blue color, right, push forward 6 months, and the 12-month interest expense as a percentage of public debt outstanding. So you can see that the blue line tends to lead the black line, right? So with interest rate where it is now, we expect, right, the interest expense to move up, right? The question then is that how soon will we revisit the 50% mark? And meanwhile, the dollar has weakened, and it is now trading below the 200-day moving average. And because it is so far away from the moving average, it tends to show a correction. So here we have the difference between the spot and the 200-day moving average. So it's not surprising that the last few days we are seeing a little bounce here. But given the situation where we have an extremely stimulative fiscal policy, and we're going to have interest rate cut, that combination often spell a much weaker dollar in the near term. Energy, energy is something that I worried about because it is a very extreme cyclical inflation, right? And we have seen how oil prices came down, but so long as inventory remain low, right, then the tendency is for it to lead to a restock pile and the oil price to move up, and that's going to create some inflationary pressure again. Meanwhile, gold, it's another indicator for me to watch whether there's going to be any sign of the domestic investors here thinking about inflation. And now we are seeing that after a long period of liquidating their gold, the investor in the gold ETF has started to buy gold again after the huge move up, right? In any case, if the demand for gold from domestic investors come in, that could be a sign of anticipation of the Fed losing control on inflation, or the Fed is doing what it takes to let inflation move up again. All right, Dan, back to you.
Thanks, Mike. Looking at those charts, last week I did show the interest expenses versus tax revenues, and I'm glad you showed the percentages this week. And the interesting thing was the interest payments as a percentage of total tax revenues, as we've shown in the past, has reached as high as 50%, and we're currently mid 30% now. So to me, it's a relief that it can get even higher. But like you said, if the U.S. was run like a business, it would be under some real financial stress. However, we do have this ability to print our currency and to keep selling our debt, and there seem to be plenty of buyers. And one thing I'm interested to see is central bank gold buying, if that's slowed down, especially now since gold is at the 2,500 per ounce mark. Because the central bank buying slows down, then that could be a sign that maybe that run in gold is over. Because as we all know, usually it's the retail investors that get in last. So we'll see. And you're pointing out that the gold ETF, the mining ETFs have been rising. To me, that's more of a signal of the retail buying than the large institutional buying. So I'm going to play a little bit contrarian there. The other thing that could happen is with the short-term rate cut with the Fed meeting on September 18th, we should see the short end drop, and that could increase concerns for inflation, which would mean that the long end would rise. And for me, it's shifting back to a normal shape yield curve is more important. And we have to get out of this inverted shape yield curve, because if we get the normal shape yield curve, then financial institutions can function normally. They borrow at the short end at lower rates, and they lend at higher rates. Hopefully that magic point, the 10-year will probably rise, in my opinion. But if the 5-year stays flat or comes down, then home buyers will look to lock in on adjustable rate mortgages, which are a function of the shorter end. So we'll see what happens. If that, I think I've been watching the bank stocks carefully, and they seem to be moving in anticipation of a return to a normal shaped yield curve, in my opinion. So we'll see if that comes to pass. The history is always interesting to look at, but we all have to know that the markets live in the current moment, and the current moment is, I think, anticipating better times ahead, and less uncertainty. But it all depends on who is the next president and what are their policies. And next week on the 10th, we're hosting a webinar, and we'll talk more in detail about what we think about the presidential elections and the potential policies and their impact on the markets. Anyway, but I digress. Returning to assessment of the markets, this is the Magnificent Seven names, which we've been tracking. And last week, obviously, NVIDIA dropped 7.9%. Month to date, still the leader. This for the month of August, still the leader among the Magnificent Seven, and the winner at the quarter to date, year to date, up 141%. So kind of a mixed bag for the past week. We had 4 of the Magnificent Seven names down and 3 of them up. But the month looks better. Quarter to date, a little choppy. Year to date, still pretty strong with the exception of Tesla. Next slide, Mike. The sector performance, as I mentioned, financial stocks appeared to look like they were anticipating a positive move. So financial stocks are up for the week. Strongest technology was the weakest, obviously, with the drawdown in NVIDIA that we saw and the Magnificent Seven names. And I won't run through all these, but if you look at quarter to date and year to date, pretty much solid results across all sectors. And interestingly, though, technology is not the leader now year to date. And we've got financials and utilities and communication services outperforming technology. So as I mentioned, we're seeing more breadth develop, and this is very positive. Next slide, Mike. The factor performance, spinoffs were leading for the week, buybacks as well. And among style, value stocks and dividend stocks were better performers. Lower volatility stocks also came in third on the styles. And I won't run through all these in detail. We'll just skip to the next slide, Mike. We don't have the commodity data this week. We had a little glitch in our data system, but turning to the economic calendar for the week, as I mentioned, today, 10 o'clock, the ISM manufacturing PMI, consensus of 47.5, forecast 47.5 as well. So we'll look to see if there's a pickup in the manufacturing sector. Next slide, Mike. The JOLTS job opening number on Wednesday, 10 o'clock, looking for 8.1 million versus forecast 8.09. Next slide, Mike. Thursday, ISM Services PMI looking for 51.1, forecast 51.2. Next slide, Mike. And on Friday, non-farm payrolls, unemployment, looking for non-farm payrolls of 165,000, just consensus 165, forecast is 120. So we're looking for consensus is much higher than forecast, which is kind of interesting. At 8:30, we also have the unemployment rate, consensus 4.2 versus previous 4.3. So looking for a drop in unemployment rate, forecast is 4.3. Next slide, Mike. Turning to S&P 500 companies, we're really wrapping it up here. Dollar Tree reports Wednesday pre-market. That'll be interesting because last week Dollar General had pretty poor numbers and the stock got walloped. There is some stress on the consumer, especially at the low end. And as we know, Dollar General and Dollar Tree could be under pressure from weaker spending from the poorer part of the population. So we'll be watching that carefully. Hormel Foods, consumer staple names reports on Wednesday, aftermarket, Copart, and Hewlett-Packard Enterprise. Followed Thursday on Broadcom and Kroger on Friday. So some meaningful names that are reporting. We'll be watching Hewlett-Packard Enterprise and Broadcom for additional signals in the AI spending and some consumer staples and with Hormel and Kroger. So we'll be watching developments there. Hopefully food prices are coming in and consumers are still spending on packaged food and shopping at supermarkets. Next slide, Mike. And as I mentioned earlier, we are going to have our webinar Tuesday, September 10th at 1 p.m. Eastern time. And we'll give our forecast for stocks and interest rates for the balance of the year. And we're going to go out on a limb and give our forecast for the presidential election and talk about the best risk reward opportunities after the election and give viewers plenty of time to ask us questions in our Q&A session. Next slide, Mike. And to sign up for this, please contact Cleveland Ashley. His number is listed here and contact information, and please indicate your interest, for more information on our products or services, or to sign up for the webinar. We'd like to see as many people join us and participate. And we hope to learn as much from our viewers and participants as hopefully you are learning from our weekly investment outlook. So thanks for tuning in today. And I'll be signing out here. And Mike, you have anything you want to add?
No, just hope everybody had a great Labor Day, and now it's back to school and back to work.
Okay, that's right. Back to work. Take care, Mike. Take care,
Bye-bye.
everyone. Bye-bye.
Bye-bye.